And as always, we're going to be looking for accurate context, good risk management, and always exercising good patience.
Everybody who's traded has gone through periods of time where their strategy hasn't worked.
Where if not a hard stop, you should reevaluate the trades you're in based on time.
That's what we're here for, is to put ourselves in the best success. A trading routine does that, builds that habit, lets you know what to work on, what to reflect on, and what to improve on the next day.
Go. Hello, everybody. Welcome to the Coach's Playbook. It's Tuesday, April 11th. I'm joined by Hogue, Mick, and JD. Dan is on the DL today with a case of broken voice or something like that. Yeah.
Which I've never heard before.
Yeah, I know. That's a new one. I think he's on like the 4 to 6 week DL. He's got to stop screaming at his country shows. But without Dan today, we are still going to talk about a very interesting topic. We are discussing the difference between trading strategies in range bound versus trending markets, of which there is a lot to talk about. But first, Mick, live from the Board of Trade. I hear you have a trader shout out for us.
I do. Big shout out to Alexandros Maios, up $5,500 today. So it's a really good day today.
Good show, Alexandros. So we want to get that trade going down like Alexandros. You got to recognize if you're in a raging or trending market. Hogue, since Dan's not here to correct me for going to you first, you have the most experience. I thought maybe we could start with you and sort of your strategy differences when you see a market ranging versus trending.
Well, thank you. And hopefully Dan will be feeling better and back with us soon. But I mean, when it comes to two basic market states, there's two. There's trending market and there's ranging market. And they do have, in my opinion, some pretty major differences, especially when it comes to strategies. When I'm looking at the markets, I'm always thinking about the auction process. Is the auction one directional or is it two-sided? A one-directional market is a trend. A two-sided market, buyers and sellers meeting freely in a certain area, is range bound. If I'm expecting a range bound day, like my main hypothesis is we're going to establish a range and we're going to stay inside that range for the day, the strategy is quite simple. Wait for the extremes and fade them. Sell near the high, buy near the low. Sell near the high, buy near the low. Sell near the high, buy near the low. Ad nauseum until something changes. When something changes, you may go from that strategy. Let's say the market breaks to the upside out of that balance area. You may run into a situation where the market begins to trend in one direction. In that regard, I'm only looking for opportunities to buy the market on weaknesses. If the market is trending higher, I'm buying pullbacks, buying pullbacks, buying pullbacks, buying pullbacks. We don't know how far a trending market can go, but at least you get the opportunity to ride the train, if you will, and you're not going to be fighting the actual move. So many futures traders, especially newer futures traders, if they can't buy it, they just turn to the other side and start to sell it. And that's when you run into trouble. A directional trending market is something you certainly don't want to fight.
That's a good point. Hogue, some people out there might be subscribed to your weekly levels. And in your weekly levels, you, for each of the markets that you break down, talk about the market structure being upward, downward, or what's the JD?
Sideways.
What's the third? Sideways. That's the word you use. That's kind of how you're looking at it, as far as whether it's been trending the last week or so.
Right. Yeah. In a little bit of a longer time frame, you would certainly say at the end of this week, if crude oil doesn't break out of this range it's in, it is sideways.
Sure. And before I head over to someone else here, in the ranging markets, you talk about buying and selling extremes. Where do you where are you looking to get out of those trades as far as profit targets? Because in a trending market, it's a little easier because if you are on the side you want, you kind of let it go, see where it can take you.
Right.
But on the range bound, if you sell an extreme and it's coming back, it's getting less extreme. So I'm sure you have different ways you go through that, but what's a general way to think about it?
A simple way to deal with profit targets. You're near the upper extreme of the range. You get short. It starts going your way. Where do you get out? Well, if you have multiples on, my first out is going to be basically at the point of control, somewhere in the middle of the range. My second exit will be value low, the other extreme of the range. If I'm going to cover the short down there in range bound trade, I'll start looking for an opportunity for the long. If it's not, depending on the amount of risk I have at the extreme of the day, those types of situations, I may go straight from short to long below value because I'm expecting a range bound day. So I'm looking for the market to kind of rotate higher to lower to higher to lower to higher to lower. So with multiples on, the point of control is the first out. The second out is the other extreme of value.
The old puke reverse.
Yeah.
There you go. So Mick, we'll go over to you. Which do you prefer? Range or trending? And how do you go with that?
Excuse me. I am less of a range trader and more of a trend trader. I think that, people who are day trading or trading from, from anywhere from, shorter time frame to higher time frame, I think catching a piece of the trend is, for me, at least personally, where I've seen myself more profitable and seen other traders more profitable catching a piece of the trend for the day. I like picking direction and I like finding good low risk entries, risk reward, and then slapping it on and seeing if it moves. All that being said, everybody's got different strategies. I have traded ranges before. I've heard Hogue talk about range trading for years now. And I mean, he lays it out so well. I always like hearing him talk about the range trading. Everything he says makes 100% sense on that. When it comes to range trading and trend trading, your risk there is that, a range goes from being a range to starting a trend. You have a breakout to the upside or the downside. And then, your risk on a trend trade is also, the trend reverses or stops. So I'm a trend trader, but also market states change all the time. Me being someone who's, got a background in the grains, and you look at corn, for example, corn has its times for volatility, but, typically it's a narrower, range for the day and ATR based on the dollar amounts and stuff like that. So, if you can see these things, going back to Hogue's weekly kickoffs, what's the direction, up, down, or sideways? That should be your approach for every market, and you should take a top-down approach with that. And I'm talking, you don't need to always look at the daily or the weekly charts every day, but what's the daily trend for the day? And then I'm a huge advocate, whether you're looking for range-bound trades or trending trades, annotate your charts. If this is your range, draw a box there. Draw a 50-yard line halfway there. Hogue said, buy it at the low extremes, sell it at the high extremes, and kind of peel off a little bit. I think also if you are a range bound trader and not someone who's looking to catch a significant piece of the trend up or down, I think you also have the ability there to maybe trade a little bit larger. If you're range bound trading, there's a little less volatility, and in lower volatility, it is okay to increase your leverage or position sizing. And in doing so, you do want to be very flexible. If I'm buying at the lower end of the range, as it hits that 50-yard line or the middle line in my range, I'm starting to peel off. And, whether you wait for it to go to the top extreme to, exit the rest, it's good to peel off part of your position, because when you're peeling off your position in range bound trading, you're not only locking in profits, you're also limiting your risk exposure too, as you lighten up your position. So I'm not sure what else I have to say on the
Well, I have
topic.
one follow-up actually from what you
Please.
said, because this may be conflicting. We'll see what you say here. We usually recommend that traders focus on a small number of products, but you mentioned that you are a trend trader. That is your preference. Do you tend to rotate into products where there is a trend, or would you rather just trade less if the product that you trade is in a range? Like, will you go to a product because it's trending?
Great question. Absolutely. Absolutely. I like a technical approach to the market. So, get to keep fundamentals aside a little bit, and, fundamentals play out in the technicals. I found myself, over the last handful of years trading mostly energies. Those markets have been trending, and when they're not really trending, I'm not taking trades. So I like keeping having an idea of what all these markets are doing, up, down, or sideways on a daily or weekly. And if there's some movement there in a trend, I might stalk a market, 3 weeks before I find an area where I like to get in on a pullback and hopefully see continuation of that trend. Lately, and when I say lately, over the last handful of years, I'm not playing around or taking risk on range bound markets. It's just not it's not where I've, kind of found myself grow into, or it's not my wheelhouse.
I want to get into this when I hand it over to JD here. I do think that there is, I hesitate to call it a consensus, but I was just reading some futures book that was talking about how most retail traders will find the ranging markets more difficult. And I agree with that. And JD, I'll get it to you, but especially with trading outrights, in my career, we did a lot of fading and loved range bound markets, but we were trading spreads and butterflies, which I think are configuration. When you're hedged like that, those are more conducive to trading ranges because they're not outrights. You're not taking that risk. JD, I guess I'd throw it over to you and be do you agree with that? And when you were trading, besides the market making part, because that's out the window right now, were you more in line for the trend, or are you against this thesis and say like, hey, range all the way, baby?
I'm going to play both sides here. I think it's possible to range trade in a trending market also. It really just depends on your behavior and your appetite for risk. Are you a more passive trader, or are you more aggressive? Do you like the buy and hold strategy versus trading both sides of the market? Obviously, your potential for loss is greater for range traders simply because by design, you're making more trades. And the odds are simply against you. The more trades, it's like sitting at a blackjack table, the longer you sit there, the worse your odds are going to get, right? But like I said, you can trade. I believe that you could trade the range in a trending market. It would depend on how proficient you are at trading both sides of the market or fading trends, like you were saying, and pretty much how good you are at identifying and drawing effective channel lines. The strategy essentially becomes, the Bollinger Band method, which I'll talk about in a second. It also affects what your exit strategies are. If you're trading ranges, basically you're using bracket orders. That's how I would do it. Obviously, you'd set up you define your risk and your profit target immediately upon entering the market, and that's it. Whereas trading a trend, where your stop is, but your exit strategy could be a little different for taking profits. You could time yourself out of a trending market. If the market's not doing what you expect it to do within a certain amount of time, you're just exiting, or you're just picking a spot of invalidation of above that you think the market is targeting. But as far as controlling risk, trading ranges, I know Hogue was talking about fading extremes, but you also want to avoid those false breakout scenarios too. So I'll typically use that Bollinger Band method where, you have your channel line and you have your middle point for each channel line. And basically you're waiting for the market to cross through that 50% mark and then exiting at the far end, So you're trading the long side of the market, you're waiting across the midpoint, and then you're exiting at the extreme. And then if you're going to fade it, play the short side, then you're waiting for the market to come back down inside of that range value, cross the 50% mark, and cover at the bottom extreme. That's how I would control risk in a range trading market. Does that make sense?
Yeah, I think that's a great way to do it. I think just to reiterate what we're saying about trending markets, then we have a great question from the comments, but is that you can be right way less and be profitable with the trending trade, where you can get stopped out a few times trying to take it the trend, and then the fourth time it runs, and you get those runs that you don't get. You got to be right more basically with the
I want to add to what you were saying about, the one time it runs against you. So Hogue said it very well again, be a buyer on the lower end of the range, be a seller on the upper end of the range. But if you are taking shorts around an upper end of a range or buying at the lower end of the range, you have to think that there are other participants that are trading this way as well. So what happens when you break out to the downside of that range or to the upside? You have to assume that once you break out of that, it draws new interest and participants into the market. And, if you break out to the upside, people are going to hammer that market with bids. There's going to be aggressive buying. You just changed the whole market state from range bound to, well, now we're making, new price discovery to the upside or the downside. People pounce on that. People also, this is, I've heard a lot of traders say, oh, they know where my stops are and stuff. No, people don't know where your stops are, but I could sure assume where your stops are going to be. I know there's going to be a buy stops above a swing high of the day. I know they're going to be buy stops above a range, whether it's a daily range or a weekly range or a monthly range or just, even a bigger time frame range. There's going to be stops above the opening, buy stops above the opening range of the session, but there's going to be sell stops below the opening range of the session. So anytime you have a bunch of people with their stops in the same place, like some of these levels I mentioned, anytime you start trading into those and triggering these stop orders, you are going to get a goosing or a thrust in that direction. And that itself draws excitement. And it's just a big snowball effect of how that all works.
Right. I don't know. None of us know where your stop is, but anyone can look at a chart and say, there's a lot of stops in here. And you might be part of it. So I got a question from the chat that I'll pose to Hogue, because this is a good one. It is, how soon into a session can you tell which type of day it will be? Are there things you look for to help see that?
Okay.
Real talk.
Jim Dalton says the earlier you can establish the end of day type, the better off you're going to be. The earlier it is, the more difficult it is going to be able to determine that. Looking at crude oil this morning, I know we're not looking at the charts, but it's been range bound since last Monday. Today we opened basically at weekly kickoff low. That's a level that I'm looking for longer time participants to enter into the marketplace. The market moved back into range. So you can make an assumption that if it does trend all the way to the upper end of the upper extreme of that range, it's going to fall into balance unless it breaks out the top of it. The S&Ps today, they opened higher. The opening range was initially the high of the session. We drove lower. We took out the high of the opening range, and we've extended both sides of the initial balance, which the initial balance is the first hour of the regular trading hour session. When that happens, there is a probability that the market will probably remain range bound for the rest of the day, because we've probed lower and failed. We've probed higher and failed. So the market is now telling us it's pretty happy where it is. Now, anything can happen. I'm looking at the S&Ps now. I'm thinking they have more legs to the upside, but this is just something I'm looking at. But if I were to follow the rules to the T, because we've traded both sides of the initial balance, then I'm thinking the market's going to probably remain range bound. So I should be, by all rights, up here somewhere above value, getting out of longs and looking for shorts. Because it's not going to cost me a lot. If I'm wrong, I can always adjust, go the other way, see if the breakout continues. There's nothing that's ever finite or correct or wrong in trading. So, there are days like before economic numbers that come out. You can kind of make an assumption that there's a probability of a range bound day. Markets are just going to be, traders are just going to be adjusting inventories. Bigger traders are going to be hedging just to make sure that they don't get hurt about whatever happens tomorrow.
Yeah, that's like the day before non-farm, the day before the Fed. You're unlikely to see strong trending markets into that because nobody's going to go out on the limb for that. Why would you?
Right.
That oil market is impressive, though. So for the last 6 sessions, there was that $5 gap over the weekend before last, right? Since then, that is very much a range market, although we're testing the high side of it right now. It's just been between $79 and
so look where the regular trading hour opened. 76, 79.64. It's the low of the opening range. 79.60 is weekly kickoff low. We rejected below weekly kickoff low right on the open. The opening range is the low of the session. So if we were playing range bound, we would be buying it there with our risk below the weekly kickoff low. If we bought it there, we'd be sitting pretty with a couple of bucks worth of profits.
Yeah, and
we'd be getting out now because we're at the upper extreme.
So yeah. If I may weigh in a little bit on that question,
please.
The tone for the day, is it going to be range bound or trending? I always like looking at, now we're in Chicago here on Central Time. I like looking at the 7 o'clock reading. Where is that market at 7 a.m.? Why 7 a.m. Central Time? It's because that's when volume and participation comes into most of these markets. So I like seeing where those initial impulses are. Are we going higher on low volume? Are we, going nowhere on high volume? These things will help you interpret, who's more aggressive. Can they be setting the tone for the day? And then, I encourage people to play with some statistics too. What percentage of the time that, after the opening range, the first 15 minutes, we're above the opening range. What percentage of the time do we close higher on the day? Or if we're below the opening range, what percentage of the sessions close lower on the day? Play these statistics out somewhere and help yourself make some informed decisions. I know that was something when I started trading grains, it was pretty good advice that I got from someone. And I used that, and I did, I made trading decisions based off of where we were above or below the opening range. And, there was a certain percentage of the time that, if we were above that, we closed above it. Doesn't mean it was 5 cents above it or 25 cents above it, but there were some statistics that I picked up on and was able to make some money doing so.
Well put, Mick.
Thank you, Jack.
Yeah, so I think that that's all I had to say on this one for now. There's a million different ways you can look into. There's 100 ways to skin a cat, which I still don't understand where that comes from. Sometimes these words, I just don't know where they come from.
Yeah, so. I don't know where they came from.
Yeah, couldn't we have said peel an onion or something like that?
Right. It was just like an unusual, that's some pretty
I use it too, and I'm like, why is that a thing? Why what is that?
Like, who is this person who skinned the cat 100 different ways? That's not a person I want as the handyman in my building. You know what I mean? So it's always the handyman. That's who's doing it. So anyway, ranging and trending markets, as Hogue mentioned, you're more inclined to buy. Most of our people out there buying and selling the indices. Both are in kind of an upward trend long-term going back. So, and that's their default method too. I mean, generally, Hogue knows people that made a lot of money doing it, but generally the trend of these things will be up in lack of other information. So I think that I was saying on the podcast this week that with those upward trends is I'm trying to buy weakness right now, as long as there's not any new news, right? We're kind of starved for at this point, and just got to wait for the next CPI or a Fed to come and take us to the next level. So,
Yeah.
well, thank you guys. Hogue, you got a quote for us to sign off?
Sure. This one I know is from a couple of different sources, but if your ship doesn't come in, you may just have to swim out to it. Now, I know Jonathan Winters, I think has rights to that one, but the first time I saw it was Charlie Brown.
Good man, I hear.
Good man. Good
All right.
grief.
Good grief indeed. Hopefully not too many good griefs for everyone out there. Stay safe, manage your risk. Hogue, you want to take us home?
Sure. Everything you do, every time you make an assumption or a hypothesis about the market, it's exactly what it is. It better be an educated guess. Take a look at the longer time frame. Think about what the auction process is doing. Put your game together and swim out to your ship.
We'll see you guys next week.